Think for a second about what happens when you walk into your kitchen and turn on the faucet.
Yeah, water just flows out.
Right. You don't pause to think about the municipal reservoir or like the chemical treatment plant
Right.
or the thousands of miles of underground pipes making it
No,
happen.
you just expect the water to be there.
And that is exactly how we treat swiping a credit card. I mean, you tap your phone at a coffee shop in Tokyo or a grocery store in Toronto, a machine beeps, and you walk out.
But behind that little half-second beep is, arguably, the most sprawling high-speed plumbing system for the global economy that has ever existed.
Yeah, which is what we are looking into today. Welcome to today's deep dive. If you have a credit card in your wallet or, a stock portfolio you keep an eye on, this matters to you.
Definitely.
We are looking under the hood of Mastercard's newly released Q1 2026 earnings report, which just came out April 30th.
We've got a whole stack of fresh documents to go through.
Right. Their official earnings release, their investor presentation deck, some brand new equity research from Zacks Investment Research, and a bit of historical context from Wikipedia.
To figure out what's really driving their growth
Yeah.
and what the risks are.
Exactly. We are going to find out if Mastercard is currently a smart bet or just an incredibly expensive checkout.
It's a fascinating question right now.
Okay, let's unpack this. We need to start by just understanding the sheer scale of the money moving through their network.
The scale is, honestly, it's hard to wrap your head around.
Give us the numbers.
Well, just in the first 3 months of 2026, MasterCard saw their gross dollar volume rise 7% in local currency, which means the total amount of money pushed through their network in a single quarter was $2.7 trillion.
Trillion with a T in 3 months.
Yeah. And when you look at the top-line numbers in the earnings release, that volume translated to $8.4 billion in net revenue for the quarter.
Which is a 16% increase year over year, right?
Right, or 12% on a currency-neutral basis.
Yeah.
Adjusted net income came in at $4.1 billion.
Wow.
And they posted adjusted earnings per share of 4.60, which, the Zacks data notes, beats expectations and continues this year-long trend of topping Wall Street estimates.
But as I was reading through this, I realized there is this fundamental misconception about how they actually generate those billions.
How so?
Well, people look at a MasterCard and assume it's a bank, but they aren't the ones lending me the money to buy that coffee. If I default on my bill, MasterCard doesn't take the hit.
Oh, right. No, they don't take a dime of credit risk. That is entirely on the issuing bank, the name on the front of the card, like Citi or Chase.
Because it's basically a toll road.
Exactly. MasterCard is purely the network. They built the toll road, they maintain it, and they just charge a tiny fraction of a cent plus a percentage of the transaction every time a car drives on it.
And currently, there are 3.7 billion Mastercard and Maestro branded cars or cards driving on that road globally.
Which is a lot of traffic.
But looking at the numbers, not all traffic is valued equally. The metric that really jumps out is cross-border volume.
Yes.
This is when you use your card in a country different from where it was issued. That specific volume jumped 13%. So explain how that international traffic impacts the bottom line differently than, like, me just buying gas down the street.
It is significantly more profitable for them. When you buy groceries in your hometown, MasterCard charges a standard processing fee. But when you travel to Paris and buy a croissant,
or just order something online from Japan.
Right, exactly. That transaction is infinitely more complex. It involves foreign exchange rates, different central banks, and navigating totally different international regulatory compliance layers in milliseconds.
Which means a higher toll.
Yes. Because of that added complexity, MasterCard charges a premium. These are known as cross-border assessments.
So that 13% jump means the most lucrative lane on their highway is getting heavily trafficked.
It's what drives their core payment network net revenue, which grew 12% to over $5.6 billion.
It's a massive cash engine. But here's where it gets really interesting. It seems like there is only so much plastic you can issue to the global population before you hit a ceiling, right?
Right.
Well, the traditional toll road is busy. The real reason their revenue is surging isn't just from swiping cards. It's from the service stations they've built along the way.
What's fascinating here is that you're hitting on the most crucial pivot in their business model. They call it Value-Added Services and Solutions, or VAS.
This was the absolute jaw-dropper in the Zacks report. This segment jumped a massive 22% year over year.
Yeah, pulling in $3.9 billion just in Q1.
Almost half their revenue. But when you read what is actually in this bucket, cybersecurity, digital authentication, deep data analytics, they sound way less like a traditional credit card company and more like a massive B2B tech and data security firm.
That is exactly what they have become. And if you look at the historical context, they have been aggressively acquiring companies to do this.
Like who?
Well, back in 2021, they bought an identity verification company called Ekata for $850 million. Okay. And then in late 2024, they dropped $2.65 billion to acquire a massive cybersecurity firm called Recorded Future.
But wait, why is this specific segment growing so much faster than the core payment network? I mean, I understand they want to stop fraud, but how does this translate to a service they sell to merchants?
Because as digital commerce expands, the surface area for fraud expands exponentially. Banks and merchants are losing billions.
Oh, I see.
Mastercard realizes that they see more global transaction data than almost anyone else on Earth, $2.7 trillion moving in real time. By integrating companies like Recorded Future, they build these incredibly sophisticated AI models.
So if someone steals my card number, Mastercard's AI is what spots it.
Right. Imagine a scammer clones your card. In the same exact millisecond, an automated system tries to buy a $2 coffee in New York and a $5,000 laptop in London.
Both look legitimate to the local merchants.
Exactly.
Yeah.
But Mastercard's global network sees both requests hit the system simultaneously. Their AI recognizes the physical impossibility of you being in two places at once, flags the London transaction, and instantly kills it.
All while letting me buy my coffee in New York.
Yep. So they go to the merchant and say, we won't just route your payment. We will run it through our threat intelligence network to guarantee you aren't handing over a laptop to a thief.
Wow. And merchants will happily pay a premium for that guarantee.
And it makes Mastercard incredibly sticky. If a merchant finds a slightly cheaper network to route a basic transaction, they lose that world-class fraud prevention. They stay because they rely on Mastercard to ensure the payment is safe and to get data insights about the payment.
It's a brilliant way to diversify. And it looks like they're taking that same forward-looking approach to how payments might work like a decade from now.
Because they know traditional plastic cards might eventually be bypassed.
Which brings us to their future-proofing bets on AI and crypto. The Q1 report highlights CEO Michael Miebach pushing something called agentic commerce.
Right, through their new Mastercard Agent Pay suite, launching in Q2 of 2026.
This is designed to handle automated AI-driven transactions, right?
Yeah, the idea of your smart fridge, realizing you are out of milk, automatically negotiating the best price and paying for delivery without you touching a screen.
But the crypto side is where I really have to push back a bit.
Okay, let's hear it.
The sources note that Mastercard just announced a planned $1.8 billion acquisition of a stablecoin infrastructure startup called BVNK.
Which operates across 130 countries, yes.
But earlier this year, Visa very publicly tempered their expectations for stablecoins as a mainstream consumer payment tool in developed markets.
Yeah.
They basically said tapping a card is already fast enough.
That's true.
So is Mastercard jumping the gun here? Are they wasting nearly $2 billion chasing a crypto trend?
I get why you'd think that, but you have to decouple crypto as consumer cash from crypto as back-end infrastructure. Visa is entirely right about the consumer side. Tapping your phone for coffee is already frictionless.
Right. I don't need a blockchain for a latte.
But think back to that complex cross-border traffic we talked about. The foreign exchange, multiple central banks, compliance checks. That back-end process can still be incredibly slow and expensive for massive businesses moving money globally.
Okay, so it's a B2B play.
Think of it like a massive bar tab.
Mm-hmm.
Massive financial institutions keep ledgers of what they owe each other all day long. At the end of the day, they have to physically move the money to settle the tab.
And doing that through legacy banking takes days and costs a fortune.
Exactly. Stablecoins and tokenized settlement allow these institutions to bypass clunky systems. They can settle that B2B tab instantly and for a fraction of the cost.
So by acquiring BVNK, Mastercard isn't trying to get me to buy coffee with crypto.
No, it's a long-term cross-border infrastructure play. It lowers the cost of moving money internationally, and it prevents new blockchain-based settlements from completely bypassing their network.
It's a purely defensive infrastructure play. That makes total sense. So what does this all mean for the stock? Because you look at all of this record revenues, a booming 22% growth in services, futuristic tech investments, you'd assume they are soaring.
And yet, Mastercard's stock has actually dropped 10.1% year-to-date in 2026.
While the broader S&P 500 has grown 5%.
Right. We have to look at the bear case because there are very real market risks dragging them down. Let's start with the rising costs.
Maintaining this invisible infrastructure is getting expensive, huh?
Very. Adjusted operating expenses rose 11%, driven by higher general and administrative costs and advertising, plus a $202 million restructuring charge in Q1.
But the metric that really shocked me was the rebates. The Q1 release says payment network rebates and incentives surged 23%.
It is the stark reality of operating in a duopoly with Visa.
Basically, they have to pay massive amounts of money to keep massive banks and merchants loyal to their network.
Yeah, and when those costs jump 23%, it eats directly into their profit margins. And if rising costs weren't enough, they are facing a barrage of regulatory threats.
The governments are coming for the toll road.
Everywhere you look, the UK's payment systems regulator is proposing actual fee caps. In the US, the DOJ is accusing them of imposing excessive merchant costs.
And then there's the Resurrected Credit Card Competition Act, or CCCA. That threatens to change routing rules entirely, right?
Yes. The CCCA would force large banks to offer merchants a choice of at least 2 unaffiliated networks to process a transaction.
So a merchant could choose to route a Mastercard transaction through a cheaper alternative network.
Exactly, which introduces the risk of losing massive amounts of transaction volume.
So Mastercard is making tons of money, but it's costing them a fortune just to keep their customers, while global governments are actively trying to cap what they can charge.
And all of that crashes headfirst into their valuation. According to Zacks, Mastercard's valuation looks stretched.
Give us the numbers on that.
They are trading at 24.72 times their forward 12-month earnings. That is well above the industry average of 16.52.
And higher than their rivals, right?
Much higher. Visa is at 22.41, and American Express is at 17.33.
So investors today are paying a huge premium for every dollar of profit they expect Mastercard to make.
Which means the market has priced it for absolute perfection. And Zacks currently rates them as a hold.
If we connect this to the bigger picture, the core vulnerability is that while they are a best-in-class juggernaut, the regulatory crosshairs combined with that premium start price mean that any slip-up could cause a major correction.
Or any rapid adoption of real-time rails bypassing them. It's a great company, but right now it really might be an expensive checkout for an investor.
Okay, let's summarize the key takeaways for you listening. Mastercard delivered a powerful Q1 driven by $2.7 trillion in volume.
A booming 22% growth in value-added services.
And forward-looking investments in AI and stablecoins. But an expensive valuation, rising operational costs, and global regulatory targets make it a very cautious environment.
It's a complex picture.
It is. But before we go, I want to leave you with a final, unexplored thread to mull over. It's a detail from the Wikipedia historical context.
The China joint venture.
Yes. For decades, China's massive digital payment market has been dominated by WeChat and Alipay. But in 2024, Mastercard's joint venture finally received approval to issue cards using the Chinese yuan.
It's a massive deal.
So consider what it might mean for the global economy. If a Western company like Mastercard can successfully scale inside China's highly insulated digital payment market.
If they can pull that off, it changes everything.
Exactly. Could that be the ultimate wild card that actually justifies their premium valuation in the years to come? Something to explore on your own?
Definitely worth watching.
Thank you for joining us on this deep dive. We'll catch you next time.